Hello, traders, and welcome to yet another 2024 mentorship. And today, I just want to address this common question that I've received from most of my followers. And this concerns about how to become a successful day trader. So, the key thing about becoming a successful Forex trader is to focus on the process and not gains. So, in this episode, I'm going to show you exactly what you can do to become a successful day trader. And these are the tips that, or the things that I've been able to put into practice myself, and I've tested them and seen them doing wonders or producing results. So what you need to understand is that becoming a successful Forex day trader requires high level of skill, discipline, and strategic planning, as you'll be making fast-paced decisions to capitalize on small price movements within a single day. So in this video, I offer a detailed guide to help you approach Forex day trading effectively. So the first thing that you need to understand, or the first thing that you need to do for you to become a successful day trader, number one is to master the fundamentals of Forex trading. So you need to understand the key concept. And what do I mean by understanding the key concept? As a trader, you need to familiarize yourself with the currency pairs, the spreads, the leverage, pips, and trading sessions. This is what we learn from the Forex basics. So you need to have those fundamental knowledge, that fundamental knowledge for you to start building your journey to being a successful day trader. Day trading requires quick decision making, so a solid grasp of this concept is really, really vital. So when we talk about day trading, this is actually where you take trades. You close all your trades within a day. So you can take trades in the morning and then you close them in the evening. So the other thing is to know the market hours. So knowing the market hours, this is a very powerful knowledge or skill that you can have. And in my previous videos, I've talked about, there is a video I did about trading, understanding the Forex trading sessions. And we have three trading sessions. We have the Asian session, we have the London session, and we have the New York session. Probably you can revisit that video and get to understand why these sessions are very, very, very important. But the Forex market operates in 24 hours a day across various global sessions, with peak volatility during the overlap of major sessions. Like, for instance, during the overlap between London and New York, we have a lot of volatility. So these periods often offer the best opportunities for day traders. So apart from the overlap, also the sessions will help you to understand the type of currency or the currency pair to trade based on which currency is active during that particular session. So number two, you need to develop a day trading strategy. So what is very important is to choose a primary strategy. Day traders often use one or more of the following strategies. So you can be scalping, you can be a scalper. So this involves making multiple very short-term trades throughout the day to capture small price moves. And this is actually when the market is very volatile, especially during the release of key fundamental news. The other strategy is trend following, and a trend following focuses on trading in the direction of the prevailing market trend, looking for strong trends that may continue throughout the day. Remember, we have always said that the trend is your friend. So trend following becomes one of the successful strategy in day trading. Number three, we have counter trend trading, and this involves trading against the trend, which often using overbought and oversold indicators with an emphasis on a quick reversal. Also, you can use the Fibonacci retracement basically to show you how far to be able to gauge how far the market can be able to retrace. Then, after choosing a primary strategies, the other tip that will help you to become successful is to use technical indicators. That is for those who love using technical indicators. Personally, at the moment, I don't use any indicators. But again, indicators, they are very, 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 they can help you in the beginner's level before you get to understand or to grasp the full knowledge of the pure price action. So we have indicators such as moving averages for identifying the general trend and possible reversal points. We have an indicator like the relative strength index, that is the RSI, which is useful for spotting overbought and oversold condition. You can also use the Bollinger Bands for gauging volatility and potential breakout points. About the use of technical indicators as well, I have a video in my YouTube talking about different types of technical indicators. So you can revisit that video and get to refresh yourself and to understand how we use some of these technical indicators in terms of trying to get an entry in the market. So effective day trading strategies often rely on such kind of technical indicators. And then you need to establish entry and exit rules. So clearly define your criteria for entering and exiting trades. For instance, if you might decide to enter a trade when a currency pair breaks a certain support level and exit when it hits a predetermined profit target, maybe you can use different ways to get your targets. Maybe you can, if you're trading from a support breakout, you can target the next resistance as your take profit. If you're trading supply and demand and you've bought from a demand level, you can target the next supply level as your take profit. You can also use the risk to reward ratio of 1:2. So there are different ways that you can be able to use in terms of determining your profit. And so some of the other strategies that you can be able to develop, you can be able to come along with is the different strategies that I've been able to teach you. So if you go to the 2024 mentorship playlist, I have discussed different strategies, CLT, Fibonacci retracement, a couple of them. So you can decide to use either of the strategies in that, and you formulate your own, or you come up with, you increase the probability by adding some rules that will help you increase the confluence. So number 3 is to create a robust trading plan and stick to it. So you can never become a successful day trader without a trading plan. So when you talk about a trading plan, number 1, the trading plan will help you to set daily profit and loss limits, specify trade size, which we call also the lot size, and risk per trade, and also to implement a risk to reward ratio. So when you talk about setting daily profit, loss, and limits, I've seen most of the traders, they focus on setting the profit limits and they forget about setting the loss limit. That means if you're trading and you have consecutive losses, therefore your plan does not cushion you or give you a way of making you to limit those losses, because as much as you have daily targets, you also need to have profit targets. I mean, as much as you have the daily profit, or as long as you have the profit target, it also makes sense to have the loss target. And once your loss target is hit, that tells you that you need to stop trading. And probably to some traders, that tells them that they need to go back to the demonstration account and iron out whatever the issues they are incurring, maybe probably in the live account, because that means there is something maybe they have not understand regarding a particular strategy. So determine a daily profit target and a maximum loss threshold. So if you hit either, that is maybe your profit target or your loss limit, stop trading for the day, because forex trading is all about discipline. So this will prevent you from over trading and protects your capital. So it is very important to set your daily profits and also to set your loss limit. Then the other key important thing is to specify trade size and risk per trade. Decide on how much you're willing to risk per trade. Typically, the rule of thumb, we usually say that do not risk more than 1 to 2% of your account. So managing trade size is crucial for survival in the inevitable losing streaks. And here I want to emphasize, I have seen most of the coaches or most of the trainers online say that do not risk more than 1 to 2% per trade. But again, I want to caution you here. If you are taking one trade at a time, Yes, do not risk more than 1 to 2% per trade. That is you if that is when you are taking one trade at a time. Taking one trade at a time means that you take a trade, you take a setup, so you wait until either the TP is hit or the stop loss is hit before you enter another position. But if you are going to trade multiple position, it is important for you to ensure that the cumulative risk of all your open position should not exceed 2% of your account. It is very, very important. Then the other thing that you need to understand is to implement a risk reward ratio. Aim for a risk reward ratio of at least 1 is to 1.5. That is the lowest, but I would recommend 1 is to 2 or above on each trade. So this means you are aiming to make more on winning trades than lose on losing ones, right? I'll repeat. This means that you are aiming to make more on winning trades than you lose on losing trades, which can keep you profitable even if your win rate is below 50%. So that means you can have a win rate of 40% and a losing rate of 60%, but at the end of the day, you will be profitable because of the aspect of the risk to reward ratio. The other thing is to focus on one asset. And this is where we talk about specialize in highly liquid asset or any asset that you feel that you have a deep understanding of it. That even if someone wakes you in the middle of the night and asks you about your asset, you are able to tell whether maybe the asset is in a downtrend, in an uptrend, consolidation, or roughly the price that your asset is, why is it playing around, right? So we have different highly liquid pairs like the major currency pairs, for instance, Euro USD, GBP USD, USD JPY. That is for currencies. When you come to commodities, almost most of them are very liquid, gold, oil, right? So the reason why you need to focus on one asset is for you to become an expert on your chosen asset. So studying one asset or one instrument allows you to understand its behavior, peak trading times, and typical volatility. So you're able to understand this pair inside out. So you'll be able to know the best time to trade that currency pair or that particular asset, the time not to trade. Probably you'll be able to understand the average number of pips that asset moves on a daily basis. And in a nutshell, what I'm trying to say is that you'll focusing on one asset will help you to become a master of that asset. Remember, there is an old adage that goes by. You can never become a master of everything, but you can become a master of one. And this aspect of specializing on one asset or focusing on one asset, it also really applies very well, especially in the academic field. All right. So you understand, for instance, I like giving the examples of doctors. When doctors go to the university to study medicine, they all begin in the same class. Maybe first year and second year, they're all in the same class, but it reaches a point that now they start specializing. So out of that, we will have doctors that will become neurosurgeons, we'll have doctors that will become gynecologists, we'll have doctors that will become dermatologists, we'll have ENT doctors. And that shows you the power of specializing. So it gives you or it helps you to become an expert of something. So again, specializing on one asset in trading will also save you time in terms of doing your market analysis. So instead of looking at multiple pairs, and by the time you begin with the first one, and the time you are doing the last analysis for the last pair, maybe the first pair gave you already an entry and it left you. So focusing on one pair or on one asset will help you to save a lot of time in terms of analysis. And also it will save you a lot of chat time. So you'll not be on the charts all the time because you know the best time to trade your asset. All right. So it is very important, and I would emphasize that if possible, try to focus on one asset. But what I can tell you in the beginners level, maybe you can have like six to around maybe 6 to 7 assets that you're looking at, and then you are trading these assets, analyzing them and trading them and recording in your journal, and then out of your journal it will help you to show you, it will show you, or your journal will speak to you which is the best asset for you. All right. We shall be talking about that when I'll be doing a video about trading journal, and you'll see how powerful when I'll be doing a video about trading plan, and you'll see how powerful that is. However, I have a video I did about the trading journal, and I also spoke about the same aspect, so you can just revisit also that video about the trading journal, and it will help you a great deal. Number 5, you need to use a demonstration account to test and refine your strategy. So practice with your demonstration account. Before trading live or before going live, test your strategy in a demonstration account to gauge its effectiveness. This lets you practice without risking real money. Also, it's good to journal your results. So note that your demonstration trading outcomes and look for patterns. Adjust your strategy based on what's working and what's not working. Then, after you start realizing results, or after you start seeing positive results, what you need to do is not transition to live trading gradually. So once you are consistently profitable in your demonstration account, start trading with a small amount of real money, gradually increasing your position size as you gain confidence and also as you build your skill and experience in the market. Again, I did a video this year showing you how to be able to do how you can be able to grow your account gradually, your small account gradually. Maybe you can also revisit that video and see how you can be able to take advantage of growing a small account, making it to become a big account with time. So this is very important in forex trading because again, you are just a newbie. You have just completed maybe probably taking a forex trading course, and like again, the old adage goes by, you can never test the depth of a river with your 2 feet. So you have to first of all put your first feet and very slowly, if you feel it is not depth, it is not deep, then you can now cross the river, right? So it is very, very important. Again, your demonstration account, what you need to know that is that your demonstration account will never teach you the psychology of trading. So your demonstration account will only help you refine your strategy. So the reason why you are beginning small when you jump into live account is because there'll be some emotional aspect. That is when now you start learning or realizing your emotional weaknesses or maybe your emotional strength. And remember this forex trading, it is 60% psychology. So from that, with your small account, if you have issues with the psychology, therefore, you'll be able to identify those issues and work on those issues now before you start diving deeper or before you start increasing your capital. So it is very, very essential. Number 6, you need to manage risk diligently. Remember, we said the first rule of dump in forex trading, the trend is your friend. The second rule in forex trading is that do not risk more than 1 to 2% of your trade. And this tells you now managing risk is very important in forex trading. How do you manage risk? Set stop losses and profit targets. So day trading requires quick exits. So use stop loss orders to limit potential losses. Predetermine profit targets to lock in gains on winning trades. Also, avoid over trading. Stick to high quality setups rather than taking excessive trades to make up for losses. Overtrading can quickly lead to emotional trading and substantial losses. So another way of avoiding overtrading is whereby you tell yourself that you don't take any trades if the setup has not materialized. So you need to wait for your setup, or you need in your trading plan, you need to have specified your trading plan and wait diligently. In your trading plan, you need to specify your trading strategy. That tells you that if you're following your trading plan, if you're disciplined to adhere to a trading plan, you will not take any trade if it has not materialized 100% according to your entry criteria. So also to manage risk diligently is whereby you limit your leverage. High leverage can amplify both gains and losses. Since day trading involves frequent trades, excessive leverage increases the risk of large losses. So start with a low leverage until you are most experienced. So leverage is very important, and you need to really understand how it works. And I did a video in the beginners forex course playlist. You'll find a video about leverage, and if you watch that video, you'll be able to know how leverage works. However, what I will insist on is that no matter even the type of leverage that you're using, the key thing is to ensure that do not risk more than 1 to 2% of your account, irrespective of the leverage that you're using to trade. Then number 7, you need to maintain strong trading discipline. Discipline. Follow your trading plan precisely. Discipline is key in day trading. Stick to your trading plan and avoid impulsive decisions that deviate from it. I know sometimes it's very difficult, especially on your as a new bait. It can become very difficult for you to become disciplined because there is always that urge of trading and feeling more. The more you trade, the more you feel better, or the more you feel like you are now a real trader. Until now you start losing some money, that's when the concept of discipline will sink in. But those traders that begin with the right discipline, they don't blow accounts. They will not blow as many accounts compared to a person who doesn't have discipline in trading. So even in real life, discipline is very important in everything that you do because it is discipline that cultivates success. So set a routine and trade during optimal hours. So establish a daily trading routine focusing on the most volatile hours of your chosen asset. Day traders, all day traders often aim for high volume trading hours to maximize opportunities. Like for instance, during the Asia and London overlap, or during the London session and New York session overlap, or maybe probably during economic releases, high impact fundamentals releases. That's when the market is very volatile. So the other thing is to know when to stop. Recognize when to stop trading for the day, especially after hitting your profits or loss limits, or when the market conditions are unfavorable. For instance, during low volatility periods. During low volatility periods. So what is very important, knowing when to stop is very important actually. Even in real life, it's good to know when to stop doing a particular thing. So also in forex trading, it's good to know when to stop trading. Once you hit your profit or loss limit, stop trading, right? Or maybe when the market conditions are not favorable, stop trading. Or maybe probably when you have consecutive, maybe you can have consecutive 5 losses, stop trading live account and go back to your demonstration account and try to iron out your strategy before now you resume trading live again. So number 8, build emotional resilience. Trading is very emotional, especially day trading is very emotional because day trading means that you'll be taking frequent trades or maybe a number of trades in that particular day. So building an emotional resilience becomes very important. And how do you do this? Is by controlling impulses. What do I mean by controlling impulses? Day trading can be highly emotional with rapid fluctuations. Therefore, you need to stay calm, avoid revenge trading after a loss, and don't get overconfident after a win. So, if you make a loss, most of the newbie, they tend to have the tendency of chasing losses, taking revenge trades. And what happens with the revenge trades is that you'll be taking these trades emotionally and you might overlook a few aspects, maybe in terms of technical fundamentals or sentimental analysis. And what will happen, you'll end up making even more losses. Again, if you have maybe a streak of winning trades, maybe you have 10 winning trades, you are a newbie, you become very excited, you feel very happy. And then you start calling yourself the gods of the market. When you sell, the market sells. When you buy, the market buys. And what happens is that you become very overconfident and you tend to overlook some key fundamental issues before you take the trades. And the next thing that you realize is that you'll be having you'll take some losing trades, right? You'll find yourself taking some losing trades. So it's very important to control the impulses. Also, to build an emotional resilience, separate emotions from decisions. Your plan should dictate your trading decisions and not emotions. Keeping a trading journal where you note your thoughts and feelings on each trade can help you identify and manage emotional triggers. I showed you how to do this in the trading journal video that I did. You can just revisit it so that we can be at par. Then practice relaxation techniques. So day trading requires focus and clarity. Techniques like deep breathing, meditation, or short breaks between trades can help you stay centered and reduce stress. Again, it's very, very important. Number 9, you need to keep a trading journal and constantly review it. So this aspect of a trading plan, trading journal, you can see it keeps like being more repetitive. And the reason why it's becoming more repetitive, it's because it's a key aspect, right? For you to become a successful trader, you cannot avoid keeping a trading journal. Even in your expert level, whichever level of trader you are, keeping a trading journal will always help you to enhance your profitability. So record every trade, log each trade, including entry and exit points, trade size, reasons for taking the trade, and the outcome. Tracking these details provides valuable insight into your trading habits and strategy effectiveness. Then review and analyze your trades that you have logged in the journal. So it's not only about recording, but the reason you are recording is so that you can be able to review and analyze. So weekly or monthly reviews will help you spot recurring mistakes or missed opportunities. So look for patterns of success and failure from your trading journal and adjust your approach as necessary. Then you need to set improvement goals. So having noted your failures, having noted your successes, then now you can formulate or you can set your improvement goals. Based on your reviews, set small, achievable goals that focus on strengthening your weaknesses. And this incremental improvement can significantly enhance your trading skill overnight. I know most of the traders says that journaling each and every trade or keeping a trading journal is a lot of work. But again, remember, no pain, no gain. So you have to put in that work so that you can be able to realize results. So finally, as I wind up, tips for long-term success. So my tips for long-term success, and these I'm sharing from a very personal level with my 8 years of trading experience. Number 1, prioritize consistency over profits. So aim for consistency in your trades and strategy execution. Even small, consistent gains add up over time whereas inconsistent results often lead to losses. So it's better making $1 a day than trying to make $20 a day and you end up over trading and losing trades. So it's all about prioritizing consistency over profits. Number two, focus on process and not outcomes. Concentrate on following your plan and improving your skills rather than constantly watching your profits and losses. And this is what I tell traders, all my students. Stop focusing on the monetary value. Stop focusing on the dollar value, but instead focus on the process. Learn how to become a successful trader and money will follow you, right? Master how to become a successful trader and money will follow you. There is no way you can focus on money, yet you don't have the skill to be able to make that money. So you first of all need to focus on the process and not the outcomes. And finally, stay persistent and be patient with your progress. Day trading success doesn't happen overnight. Not only day trading, but success, overall success in life doesn't happen overnight. When you see those athletes smash those golds and silver medals, they have practiced behind the scene. They have practiced. All right. They have practiced for several years. And that practice is what enables them to win 100 meters in 9 seconds, in 10 seconds. And they make a lot of money. So it doesn't come that easy. They stayed persistent. They became patient with their progress. So as a trader, as a day trader, stay committed to your plan, refine your skills, and understand that success in day trading is a journey that requires ongoing improvement. So day trading is not a sprint, it is a marathon. So day trading in Forex, it can be both rewarding and challenging. But with the disciplined execution, solid risk management, and a continuous learning mindset, you can work towards building a successful day trading career. So these are the tips that I have been able to apply in my life. I've been able to witness results or to see results out of the same. How I wish that you follow each and every tip that I have given you. And I look forward to hearing your great testimonies in regards to your improved day trading. So thank you so much. And until the next episode, keep safe.